Wall Street, top investors watching your money. Joining me right now is Grant's Interest Rate Observer founder and editor, Jim Grant. Jim, it's always a pleasure. Thanks for being here.
Okay, Maria, nice to be here.
Yeah, I want to start off with what we're expecting today. We got the consumer price index out in about 45 minutes. We had two hot readings in January and February. What are your expectations for March?
Well, there was a big trade in the derivatives market yesterday, suggesting that someone knows something or strongly believes something, and that something appears to be a softer than expected CPI reading this morning. So if that trade is indicative of what's going to come, we'll certainly know soon enough, but March looks to be a happy number for the stock market.
So Tom Lee from Fundstrat wrote, I was looking at his research yesterday, that this is the first quote-unquote clean number because January and February have all this seasonality attached to it. So he's basically saying this is going to be a soft number. It's going to indicate that inflation is coming down. Markets will rally. Should we be reading into 1 month in that regard?
Nope. And it's not clear that even if it's slightly softer than expected, that softness is a statistically significant measure. You have to stand back a little bit and look at the trend and look at what is underlying the data. So what might be underlying coming months of CPI numbers is the not so latent forces of inflation that include such things, well, as Jamie Dimon ticked off in his letter to his stockholders yesterday, including what he called the remilitarization of the world. All these investments in green technology. AI itself is a huge demand on the so-called analog or old economy. Transformers prices going up, power shortages, the need for more power, great projections of future demand for power. So it seems to me that that whatever this morning holds by way of a CPI reading, that we are looking at a future of higher than expected inflation. I think this is the age of inflation. And
that can be underlined by just looking at the price of oil, where oil has gone and come from in the last year. We're talking about now crude back up to like $85, $86 a barrel.
Yeah, commodities more broadly are rallying as well.
So right. Copper, gold.
Yeah, and the federal finances themselves are an argument to expect more rather than less inflation.
Right.
We're running a $1 trillion plus deficit, not annually, but every 6 months, or is it 6 weeks? One forgets.
Unbelievable. Yeah, it's a $1 trillion deficit because the interest just to hold that debt of $36 trillion is expensive. All right, let's talk about the Fed. The futures market currently pricing in a 58% chance of an interest rate cut at the Fed's June meeting. Atlanta Federal Reserve President Raphael Bostic echoing those expectations, saying that he's looking for this one rate cut this year, but he says he's open to changing his view if economic outlooks change as well. We'll see what the CPI says about that, but the last time we were together here in this studio, you said, look, the Fed may decide to change the inflation target. Maybe it's not 2%. Maybe they move it up. But you were not. You said maybe the Fed could raise rates. Yeah. What are you expecting from the Federal Reserve this year?
I think the Fed really, really wants to cut. It wants to cut because, for one thing, the leveraged portion, meaning the encumbered or the indebted portion of this economy, is going to gag at much higher interest rates, or indeed will be in trouble with perpetuation of existing rates. A federal funds rate in excess of 5% is a trial for many parts of this private equity, for example, commercial real estate. So the Fed wants to cut. Certainly, President Biden wants desperately for something to happen to reduce interest rates. Donald Trump, as a former real estate promoter, wouldn't mind some rate relief to enable his portfolio to do better, and therefore his campaign funding to do better.
So you're saying both sides would love a cut?
Yeah, I mean, I don't know. I'm looking for the party of balanced budget and monetary probity. That party has not been organized so far.
No.
I don't see any pressure for it. I mean, as you and your guests so eloquently put it earlier, the big issue for people seems to be the border. But despite these immense deficit numbers, despite the horrific debt service costs that are emerging, I don't see a single candidate for a higher office saying anything about our proliferating debts or the magic money that is conjured to finance them. So, I think it's an issue without a constituency, that is, our public finances. The public credit, that ancient phrase of Alexander Hamilton, is friendless. So this is a clear and present risk to the American fiscal solvency.
Yeah.
And also, it's a continuing pressure on the underlying rate of inflation.
Well, I think you make such an important point. Senator Rand Paul has raised this with us so many times. He reads your research regularly. He had great things to say about you. But when I'm looking at the Fed in 2024, Jay Powell may want to cut rates going into the election, or he gets criticized for doing so. But when you look at the actual backdrop, gold prices hitting fresh record highs this week, fueled by buying momentum. Wall Street Journal writing that this year's commodities rally is reflecting a better economy, but also could be a setback to interest rate cuts. Global commodities up nearly 12% this year, outperforming the S&P 500. In terms of what this means for a Fed move, if the Fed sees commodities going up and oil going up and the CPI food going up, how is it going to cut rates?
Well, there's all sorts of ways to pitch these data. There are as many ways as there are economists, one could almost say. So the Fed might say, well, yes, these latest numbers are not very good for us. However, we see a future of this. And
you can spin it any way you want.
You can, and the Fed in the past has. I think also I believe that the Fed itself regards a potential second term for Donald Trump as a clear and present danger to the country.
Mm-hmm. So that's why they'll get involved.
The Fed is politically very much aligned with the Democratic Party. Those numbers turn up in campaign donations, which are on the public record. And I think the Fed, without even perhaps realizing it is doing something in the way of a political move, would be inclined to read the numbers in a interest rate reduction positive way, with in the back of its mind the threat of another Trump presidency.
Wow. That's incredible. So I think what I hear you saying is that the Federal Reserve wants to cut interest rates. The backdrop will be mixed because this morning we could get a softer CPI, but longer term, more months out in the year, you're expecting inflation stays elevated.
I think so. I think we're looking at a phase of inflation, a cycle of inflation. In the 70s, the inflation rate did not go up continuously over the course of 10 or 12 years. There were 3 distinct cycles, and each one peaked and pulled back. And when they pulled back, people say, aha, we are so glad this is over. Paul Volcker himself breathed a sigh of relief when he was at the Treasury in 1971. So you never know, and anyone who pretends to know is either very young or is kidding himself or herself.
Real quick before you go, would you put money to work in commodities today, given that we've seen this run up, the momentum is there? Does it have legs to keep going?
Well, let me say, with respect to the gold market, the gold price itself, the bullion price is up, new records. What is lagging are the gold miners. I think it reflects the lack of interest in the sector on the part of Western investors, Americans in particular. So if you're looking for a part of the market that is still value-laden, with the assumption the gold price stays where it is, does better, gold mining shares would seem to be that would be a reasonable choice.
I actually got an idea out of you on equities. Jim Grant, it's great to see you.